What happens when the company that built the intelligence backbone for the CIA decides it wants to be the AI operating system for every Fortune 500? Well, you get a stock trading at 234 times earnings and investors lining up to pay it.
And the fascinating part is, the market might not be entirely wrong. Palantir's commercial revenue grew 137% last quarter, Hudson. That's not a government contractor number. That's a hyper-growth SaaS number.
Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're going deep on Palantir Technologies, ticker PLTR, one of the most polarizing names on Wall Street. Lana Chen is here to help us figure out whether this is the next great platform company or the most expensive stock in the S&P 500, or somehow both.
Let's dig in.
So, Palantir was founded back in 2003 by Alex Karp and Peter Thiel, among others. The original idea was pretty wild: build software that could connect the dots across massive, messy data sets for intelligence agencies. Think of it as giving analysts superpowers to find patterns humans would miss.
And that early government work created something really hard to replicate. Palantir is the only Western AI platform deployed in top-secret CI-classified environments. They hold FedRAMP High, IL5, IL6 certifications. That's a moat most competitors can't even begin to approach.
Today, the company runs 3 core platforms. Gotham handles defense and intelligence work. Foundry is the commercial side, acting as a central operating system for enterprises to break down data silos. And then there's AIP, the artificial intelligence platform, which is the newer product letting organizations deploy large language models inside secure environments.
The business mix has shifted dramatically. Government used to be everything. Now, U.S. commercial revenue hit $507 million in Q4 alone, growing 137% year over year. That segment is approaching half the business. They're headquartered in Denver, with about 5,300 employees spread across 43 locations on 6 continents.
And the why now is pretty compelling. The Pentagon just designated their Maven Smart system as a formal program of record. They've got a $10 billion Army framework contract, and their fiscal 26 guidance called for 61% revenue growth, way above what the street was expecting. Alex Karp might be the most unusual CEO in the S&P 500. The guy has a PhD in social theory from Goethe University Frankfurt, a law degree from Stanford, and he's been running Palantir since basically the beginning, 21 years and counting.
The Economist named him CEO of the Year in 2024, and Time put him on the 100 most influential list in 2025. He's also been the highest-paid CEO in America, $6.8 billion in total compensation in 2024. That's a number that raises eyebrows, but his track record speaks for itself. The stock returned 77% in 2025.
He's a philosophical thinker in a room full of engineers, which makes for some interesting earnings calls. He talks about the responsibility of AI, Western security advantages, and the future of human decision-making. Love him or not, the guy has conviction.
All right, let's get into what makes Palantir's financials both extraordinary and terrifying at the same time. The stock sits at $154.87, giving us a market cap of $359 billion.
$359 billion for a company doing under $4 billion in annual revenue. That's a big number.
It is, and here's why. Trailing 12-month revenue came in at $3.89 billion, with earnings per share of 64 cents. The trailing PE sits at 234 times earnings, and the price-to-sales ratio is 85. To put that in context, the median PS for the S&P 500 is around 3 or 4. Palantir is trading at roughly 20 times that.
So what are people paying for?
Growth and margins. Look at the quarterly revenue trajectory. $860 million in Q1 last year, $930 in Q2, $1.040 billion in Q3, then $1.41 billion in Q4. That's a 64% acceleration from Q1 to Q4 within a single year. Gross margins are 82.4%, which is elite even for software. Operating margins expanded from 10.8% to 31.6% in a single year. Free cash flow hit $2.1 billion, with a quality ratio of 1.31, meaning they generate more cash than reported earnings. The balance sheet is clean with about $4.6 billion in cash against minimal debt. Overall, Palantir's financial health is solid. They're profitable, cash generative, and growing fast, but the valuation requires everything to go right.
So what are the analysts saying? Because with a stock this polarizing, I imagine there's a wide range of opinions.
Wide is an understatement. Of 21 analysts covering, 14 have buy ratings, 5 hold, and 2 sell. The average price target is $195, which implies about 26% upside. But the range goes from $50 on the low end all the way up to $260 on the high end. That spread tells you everything about how divided the street is.
Any notable calls recently?
Morgan Stanley has an equal weight rating with a 205 target. Their analyst wrote that Palantir is on course to reach $10 billion in revenue at the fastest growth rate and highest margins, perhaps in software history. Goldman trimmed their target to 182 from 188, but still called the Q4 results a consensus crusher. And Rosenblatt has a buy at 200 with a focus on AIP platform momentum.
Last earnings were February 2nd. Revenue came in at $1.41 billion, beating estimates. EPS was 25 cents adjusted versus the 23-cent consensus. Both beats. And the guidance was the real firework. Fiscal 26 revenue of $7.18 to $7.2 billion, implying 61% growth. U.S. commercial guidance alone was above $3.14 billion, which is 115% growth.
The stock surged about 7% in extended trading after that report. When you're already a $300 billion company and you can still surprise the street by that much, it says something about the growth trajectory.
All right, let's lay out both sides. The bull case starts with AI. Palantir's AIP bootcamp model has slashed sales cycles from months to just 3 to 5 days. That's transformative for customer acquisition costs, and it's showing up in the numbers. 137% U.S. commercial growth.
Bulls also point to the government moat. The Pentagon's MAVEN program of record designation is a big deal. It means long-term funded military integration, not just a pilot project. Add the $10 billion Army framework and the largest ever UK defense contract, and you've got a durable revenue base that competitors simply cannot replicate.
And the Rule of 40 score hit 127% last quarter. For anyone unfamiliar, that combines revenue growth rate and operating margin. Anything above 40 is considered healthy. 127 is exceptional. It means Palantir is growing like a startup while printing margins like a mature enterprise.
Now the bear case, and I have to be direct here. The valuation is extreme. 234 times trailing earnings, 85 times sales. At these multiples, even a modest growth deceleration from 60% to 35% could trigger a severe correction. Analysts project growth slowing to 25 to 30% by 2027, and the stock is pricing in perfection through at least that time frame.
Competition is real too. Microsoft, AWS, and Google are all building comparable AI capabilities, and Salesforce just launched Mission Force specifically targeting government operations at lower price points.
And here's the thing about government concentration. It's still 55% of total revenue. That creates exposure to budget cycles, political transitions, and policy shifts. The $10 billion Army contract is a framework, not guaranteed spending. If defense priorities shift, those dollars could be reallocated.
Let's see how Palantir stacks up against the neighborhood. We're looking at Datadog, CrowdStrike, and Snowflake as comparable high-growth software names.
Datadog trades at about 55 times earnings and 18 times sales, growing revenue at 29%. CrowdStrike is at 83 times earnings and 22 times sales with 22% growth. Snowflake, which is still not profitable on a GAAP basis, trades at about 20 times sales with 29% product revenue growth.
So Palantir is growing faster than all of them, but it's trading at 3 to 4 times their valuations on a price-to-sales basis.
Exactly. The premium is real, and it reflects the market's belief that Palantir is a category-defining platform, not just another SaaS company. But it also means Palantir needs to keep delivering 70% growth, while peers are considered successful at 20 to 30%. That's a high bar.
What are the options markets telling us?
The put-call ratio sits at 0.6, which leans bullish. There are about 1.5 million calls open versus 900,000 puts. Call concentration is heaviest in the 150 to 160 strike range, right at the money, suggesting institutions are building upside positions. Put activity clusters around 130 to 140, providing a defensive floor. The overall read is that options traders expect continued momentum, but are hedging against a valuation reset.
This one's interesting. What are the insiders doing with their own money?
It's a yellow flag, Hudson. CEO Alex Karp has executed 41 transactions over 5 years, and every single one has been a sale. 0 purchases. He sold 493,000 shares at $133 in February and 585,000 shares at $164 in November. That's about $162 million in proceeds over just those 2 transactions.
Now, to be fair, most of those are part of pre-planned 10b5-1 trading plans or RSU vestings, and Karp maintains massive control through Class B supervoting shares.
That's true, he's not abandoning the ship. But the fact that no executives are deploying personal capital to buy shares at these levels tells you something about how insiders view the current valuation.
Pulling it all together on the risk side, what should investors be watching?
The key metric is commercial customer count growth and deal expansion rates. If AIP bootcamp conversions slow or average contract values plateau, the growth story weakens fast at these multiples. Watch the fiscal 26 quarterly results against that 61% guidance. Any hint of a miss could be violent given the valuation. Government budget developments matter too, especially with political cycles. And keep an eye on share dilution from equity compensation. The share count has been expanding, which could pressure per-share metrics even as revenue grows.
The next earnings report will be a big test. If they can show continued acceleration in commercial and sustained government momentum, the bulls stay in control. Any cracks, and this is a stock that could give back 20 or 30% in a hurry. So what's the bottom line on Palantir?
This is a company executing at a level we rarely see in enterprise software. 70% revenue growth, 32% operating margins, $2 billion in free cash flow, and a product suite that sits at the intersection of AI and national security. The moat is real. The growth is real. The question is whether all of that justifies a $360 billion market cap for a company that just crossed $4 billion in revenue.
It comes down to your time horizon and your conviction on the AI platform thesis. If you believe we're in the first act of an AI revolution and Palantir is the operating system, the valuation might look reasonable in 3 to 5 years. If growth decelerates faster than expected, this could be one of the most expensive lessons in the market.
The metric to watch is U.S. commercial revenue growth. If it stays above 100% through the first half of fiscal 26, the premium holds. If it dips below 60 or 70, the market will reprice quickly.
I want to close with a quote from Alex Karp himself. He said, "We are still in the earliest stages, the beginning of the first act, of a revolution that will play out over years and decades."
Whether you agree with the valuation or not, you can't deny the ambition. And that conviction from the top is what keeps the growth engine running.
That's going to do it for episode 76 of Charged Alpha, our deep dive into Palantir Technologies. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.